Good evening, investors. Hi, Sundar sir.
Good evening,
Good
Naufal.
evening. So we'll start the session, sir.
Okay. Thank you. Thank you, Naufal.
Yes, sir. So I would like to just give a quick, intro of Sundararaman sir. So Sundararaman sir is an active angel investor. He has made overall, 40 investments till date, which consist of 14 in US and 26 in India. And also, he's, advisor and mentor for many of the startups in US and in India. He's a seasoned technology entrepreneur with over 30 years of experience in tech industry. And he's the co-founder of Wilco Source. And I'm happy to welcome Sundar sir.
Thanks, Naufal.
Over to you.
Good afternoon to all fellow angel investors. I'm Sundar Ramasamy. I'm a US citizen, but I think I have come at the right time to India to participate in Startup Singam Season 2. And I would like to congratulate Startup Singam for the successful Season 1. It was great, Naufal. I have watched all the
Thank you, sir.
episodes.
Thank you, sir.
Shall I share the presentation?
Yes, sir.
So I wanted to put a small disclaimer. First of all, I am not a legendary investor Warren Buffett. Okay. Am I audible, Naufal?
Yes, sir, you're audible, sir, and your screen is also visible. And
Okay.
also for the investors, if you have any questions, you can write down on the chat. We'll at the end of the session, we'll have a Q&A, and the questions will be answered.
Thank you.
Thank you, sir.
So please, take my speech here as a general guidance and not as a Bible. Okay. So you are solely responsible to make all the investment decisions. And I would like to reiterate one more thing as what Chandrasekhar Kuperi mentioned in the last Zoom call. The angel investment is not for fainted heart people. Okay. So do the due diligence properly, and there are so many risks involved. And I'm going to cover today the mindset of an angel investor and the best practices. Basically, it involves like investing psychology, the decision-making processes, and the strategies for successful early stage investments. And these are all the key contents I'm going to cover. Just the introduction, the angel investor psychology and decision-making, due diligence frameworks, portfolio strategy and diversification, risk assessments, best practices and success factors, market trends, some case studies, and common pitfalls to avoid, mainly the exit strategies, key takeaways, and actionable insights. So, as an introduction, first of all, I would say that we angel investors are more critical even than like a venture capitalist for the economic growth and the innovation, because we are the ones taking risk in investing the early stage startups. Usually, all the startups will go to VCs only after Series A or the Series A stage. But we are taking risk and investing in pre-seed and seed stages. And moreover, we are like a high net worth individuals investing our own personal money. If you take VCs, they do like a syndicate. They raise funds from so many people and they invest. So that's why I'm saying we are more risk-taking people than VCs. And I would say that angel investor not only invest money, they provide mentorship and also strategic guidance throughout the stages, especially the pre-seed and seed. And also they introduce other people in their network, other investing people to raise more funds. They help for the subsequent fundraising also. So in the angel investing ecosystem, basically early stage startups, angel investors, growth and innovation. And some of the key psychological factors are, mainly like a personal connection. When we hear about some startups, we get influenced by either the founder may be like a known person or the problem they are solving like related to us. We might have already invested in similar companies, or we might have heard some success stories of that particular business solving that problem. And also another one is, this is the important one, fear of missing out. Sometimes it creates urgency in making investments. I have done a mistake, this fear of missing out. I will explain you later in the presentation. And the anchoring bias. Sometimes we get influence from the valuation of the company, like initial valuation, mainly initial valuation, like how much stake we will be getting in the cap table. When the valuation increases, we think for example, the valuation gets doubled, we think our investment also will get doubled. That's not the case, because of the dilution and all other things. But also like a familiarity bias. As I mentioned before, sometimes the domain the founders do will be very familiar to us. That would influence us to make the investments. Then the pattern recognition. We may have heard some success stories. For example, I would say, like Instamart, Zepto, Blinkit, all are making very good money and revenue. If we hear about a startup similar to that domain, we might get influenced to make the investments, but we are not sure whether the another new company will be successful or not. And also the risk tolerance. We have to understand what is our threshold, how much we can invest, because all these startups are totally uncertain, right? In the beginning, by hearing the pitch, we would think that it will be a great hit and we can get more returns. But we should, first of all, calculate our threshold. We can take the calculated risk based on the how much we can invest in the startups. So then the decision making flow, initial impression, which is like we will get the pitch deck and we will have sorry.
No, sir, actually, you can continue, so I'll just.
Okay. Initially, we will get the pitch deck. We will have like one-on-one call with the founders or other senior leaders in the company. Then we will do some kind of researching about the business, what they are trying to solve, and also about the founders, their history. Nowadays, everyone would search their history on LinkedIn, what they have done before and what all the businesses they have run so far. Then the team evaluation, who is the COO, CFO, other senior leaders, and we would do the team evaluation. Then market analysis, whether the product is the right fit for the market for that time. Only then the team negotiation comes into picture, like what kind of valuation. Sometimes the founders will go to their chartered accountant to get the valuation. I have seen many startups with the overvaluation. And if you ask any question about the valuation, they are not able to explain very clearly why that valuation was derived. Only based on all these things, then we can make some kind of a decision whether to make investment or not. Then the due diligence comes into picture. The due diligence is very, very critical for the angel investors to make investments into any startups, because that due diligence will uncover so many things. And also whatever we have assumptions so far, we can validate all those things, and also all the risk, the uncovered risk will come into picture only in the due diligence process. Some of the due diligence checklist, not some, but these are all the key due diligence checklist, I would say. The team is assessment and the market analysis. Hello? I heard some noise. Okay. The technology, whether it's like a software services company, nowadays AI is doing the playing a big picture, then the business model, how they generate the revenue, and what are all the expenses they make, what is the margin, gross profit margin, and also the net profit and EBITDA, all those things we will check. If they already have some kind of reports, it would be easy to validate. Otherwise, we may have to talk with their chartered accountant to get all the numbers. Then the financial review, as I said, the projections. Sometimes, we may get influenced by the projections. Some of the companies do over projection. When they come up with the projections, if you ask questions like, okay, for example, okay, for 2026, you have come up with this kind of projection. How would you generate this revenue? Do you have any customers in the pipeline to generate that kind of revenue? If you start asking those questions, some may be able to explain, but most of the time we may not get a correct explanation. So we have to do all those things. Then a burn rate is very important. How much is the expense per month? Because only with the help of a burn rate and the cash on hand or in bank, we will come to know about the runway, which is very important. For any startups, I would say that this is what I have. They should have at least 18 months runway at any point of time. Only then they can be like a successful startup. Then who are all the competitors to those startup? Then legal compliance. This also plays a big picture. What kind of contracts they have put in place between us, like angel investors, and the startup company. Then the corporate structure, and there are very many regulatory issues, and the Indian government expects lots of things to be compliant. So we need to check all those things. Then the exit potential. What is the exit strategy they do have? Whether they targeting merger and acquisition, or they can exit. They will exit us in the secondary sale or IPO. IPO is a very rare thing to happen, but sometimes that also happen. Then on the due diligence process flow, initial screening, especially pitch deck and the business plans, and the key metrics. We have to analyze their key metrics like revenue, cost of goods sold, gross profit margin, other expenses, net profit margin. Only then EBIT comes into picture. And as per the industry standard, 10% of the EBITDA is like, if any startup or any company makes 10% EBITDA, that's a very strong company. But that may not be the case for the startups. That will take at least 3 to 5 years to reach that point. So until that time, angel investors have to be very patient. Then the deal structure, as I said, valuation, terms, legal documentation, and I would suggest that angel investors should have a legal expert to go through those documents, to review those documents. Even a small word or small sentence will change everything at the end. We won't. We will regret only at the time of exit, not until then. So that's why I'm saying those are very important. So basically, what I look at here, I have mentioned a very comprehensive checklist. It is not easy to do all those due diligence if we don't have like a dedicated team to do the due diligence. So in my case, I'm the only person reviewing all those things. So I don't have a dedicated team. So this is what I do. For smaller ticket size, I just look at the overview of founders business. What is the revenue number, burn rate, cash on hand, how much data they do have. Then the runway, as I said, then break even. When they can reach the break even point, in 2 years, 3 years, or 5 years, I will look into those things. For larger ticket size, I look at all the above items I mentioned. Then I will research on team, the valuation check, then the cap table, how many people are in the cap table, what percentage each person will have. I would check all those things. Then the projections and litigations, whether they do have some pending cases. I have seen some startups with some pending legal issues. So those things need to be analyzed also before making any decision for the investment. So because of these reasons, I started investing via syndicate because I felt syndicate is the best option because a syndicate, the company would do detailed due diligence since I don't have any like a dedicated team for the due diligence purposes. Then the portfolio strategy and diversification. Diversification is very crucial for angel investors, mainly to balance the risk and maximize the potential returns. Why the diversification matters? If you look at the statistics, 50 to 60% of an angel investments return less than the original amount what we invest. 30 to 40% returns between 1 and 5x of the original investment. Only 10 to 20 percentage deliver 5x plus returns. A very rare case, as I mentioned, between 1 and 3% deliver extraordinary return, like 20x or even more. Then our portfolio strategy, right? Based on some studies, investing in 10 to 12 companies is the bare minimum. But the ideal scenario is investing in between like a 20 and 25 companies. And also we should not invest in all those companies in 1 year or in 2 years. We have to spread out our investments from the time perspective also. So investing in those 20 to 25 companies over the period of like 3 to 5 years. Then also, this is the main advice. The angel investor should not allocate more than 10% of their net worth to invest for the investment reasons. That is the safe bet. Then what are all the risk assessments we should look at? The team risk, mainly the founder's experience, what is their commitment, and whether they do have CFO, COO, CIO to take care of all other things. If there is only like CEO exist, it's very easy to say that the CEO cannot do or take care of all other departments. It's a very big challenge for them. So we should check how many people in the senior team, especially. Then market risk, whether that the business or product they do is the right fit for that for the market for that time. Because some products work well in the United States or some other countries, but that might not be the right fit for India or like a Tamil Nadu. So we have to look into those things also. Then also like who are all the competitors. Then product risk, whether the product is in like only the idea stage or development stage or go to market stage, we have to check all those things. Then, as I already mentioned, financial risk. What is the capital requirements, burn rate, and the path to profitability? How long they are going to take to reach to go beyond the break-even point, which is important from the angel investor perspective, because we all do invest expecting some kind of returns, from the startups. So that's why I keep saying that's very important. Then the legal risk. If it is there is like intellectual property, who is the ownership? Because initially we won't think of those things. At the time of acquisition, these IP come into picture, regulatory compliance, and also their litigation history. All these legal things when come into picture at the time of acquisition or IPO or some other big institution going to be like a funding into that startup, because they do detail very exhaustive due diligence. So that's why these are all the things important. Initially, we may not care much. And also like a deal breakers, the lack of founders integrity or transparency, the unclear ownership of the intellectual property, unrealistic financial projections. Sometimes what happens, let's say the founder may have a company A and also a company B. Company B develop projects and company A raise funds. Company A pays money to the company B, like a commingle of funding. So that will create so many problems, issues when the founder goes to some kind of VCs or big institutions. Then framework, we should have like a proper framework to evaluate the team evaluation, market validation, product assessment, and also legal review. If we keep a kind of a template for each and every risk categories and assessment, it will be straightforward and much simpler. We can even assign the task to someone else. Hey, just to follow this template and put all the inputs in the template. Later, we can review and make the decision. And the best practices and success factors. So mainly the angel investors differentiate themselves through very disciplined approach and also some kind of strategies, with their portfolio companies. As I mentioned before, 10 to 20 investments is a bare minimum, but 20 to 20, like 25 ideal. And a thorough due diligence should be in place, and focusing on the founders and the team dynamics is important. Then also investing in familiar industries or sectors also will help us, because we know what will happen, whether that's a right product or viable product for the market. So we can easily come to a conclusion. Then setting the clear investment thesis and criteria. First we should come up with some what kind of ticket size we can afford and we should invest, because the founders while coming for fundraising, they may say 25 lakhs is the minimum ticket size or 10 lakhs is the minimum ticket size. But angel investor can always negotiate. We can always negotiate by saying, hey, only 5 lakhs I can invest. We can negotiate all the terms and everything. We should not put all the money in the same company. That is not a good practice. Then also angel investors should help the founders of startups by providing a guidance or mentorship or a network connect, beyond the investments. Only that will help the startups to go to the next level. At the same time, we should plan for the follow-on investments with the same company. Because if they do well, definitely once the pre-seed is done, they will come back to us for the seed round. If we do have some kind of capital allocation for the seed round also, if they are really doing great, then we can invest in the seed stage or Series A also. But usually for Series A, they go to the private institution or venture capitalist. Then key best practices. It is always a good practice to collaborate with other angels. Like now, thanks to Startup Singam, they have created a WhatsApp group with all these angel investors. So I requested the Startup Singam to keep this group as is. Please don't close the group. We can discuss or we can share any like a startup information or for any kind of clarification or questions.
Definitely, sir.
And also, we should plan the exit strategy very early. While talking with the founders or investors, we can clearly say, hey, please exit me, at the time of secondary sale, like at the time of fundraising in Series A or Series B. So we can clearly mention on all those things. As I said, IPO is a very rare case. We should not wait until the IPO. If the money comes in the through the secondary sale, we should grab the money and at least we can make investments in some other companies. Sometimes we get greedy, so that's not good. Market trends and key statistics. So based on this 2024 and 2025 key trend, there is a 6% decline in angel group investments compared to 2023, meaning the selection process, became more only like angel investments happening only for the selected companies and also on selected founders. And also handful of startups failed to raise the subsequent rise of funding. So that is also another issue we may have to face. They can rise successfully in seed, even like a pre-seed and seed, but they may fail in raising while raising the Series A. That is also big risk. And also angel investors are now even exceeding VC's funding especially for the startups. So as per the data, like 24.1 billion US dollar deployed as angel investments in the early stage startups. And there is like a sector shift also. Now AI plays a key role. The climate tech, go green, healthcare coming up with so many innovations, and especially after the pandemic, lots of things happening in the industry. And I'm like to reiterate, only 10 to 20 percentage of angel investments yields 5x plus returns. 50 to 60 percentage returns less than our principal money. 20 to 25 is the recommended portfolio size, and 10 percentage increase in exit probability with angel backing. The growth pattern, especially in India, across the globe, India is at the third largest startup ecosystem globally, with over 1,900 active angel investors, especially in just Q1 2025, and a total of $3.1 billion amount invested in that quarter alone by angel investors. And the emerging market shows 30% annual growth in angel activity. So India is doing good, and lots of new companies have started with innovative ideas. And if you look at the key players in India, especially on the angel investment side, these are all like a few key players, like Kunal Shah, founder of CRED, Anupam Mitte, Sanjay Mehta, Binny Bansal, and Rajan Anandan. All of them, with their portfolio size is like a couple dozens to hundreds of portfolio companies. And also they have exited with large returns. Some real world example. So I have put example for success, challenge, and also like a failure. They tried, but they failed. So the first one is, the group of angels invested like only like a 200K US dollars in the pre-revenue from payment processing company and taking like a 15% equity stake. The founders faced so many issues. Then angels provided some kind of good connections for backing the startup and also to raise more funds. Later in 2022, that company got acquired for 40 million, generating a 30x return for angel investors. So what shows here is some kind of domain expertise, active mentorship, helped that startup for a success and also for the big return to angel investors. And the challenge. So this is another example for like a challenge. The angel in syndicate invested like a $500,000 US dollars. It's a very promising like biotech startup, but they have some kind of IP issues. They haven't looked properly how to fix it and everything. The company folded after 18 months because of that IP issue. That's why I mentioned the IP, all the legal term also should be looked in the beginning itself while making the investments. And the third one is the company started, facing problems, but with the help of angel investors, the company became successful. So these are all like a common pitfalls to avoid, like a poor diversification, inadequate due diligence, emotional investing, like a fear of missing out, some kind of ignoring red flag. While getting the report from the startups, sometimes we may overlook at the data on the report. So we should, review the reports very carefully. And also main thing, we should ask related questions either to the founders or to the chartered accountant of that startup. No follow-on strategy also. If you don't have proper allocation for the follow-on investment, we should keep some kind of money for the follow-on investment. Then unrealistic timing expectation. We cannot expect returns in 1 year or 2 years. We should wait at least 5 to 8 years for the successful returns. Some companies, may get acquired in 3 years or 4 years, but typically we should wait at least 5 to 8 years. Then the pitfalls, focusing on only one company, investing more money into one company, then also portfolio approach. We should have diversified domains and diversified portfolio, and relying on one person judgment or one person's decision, ignoring like collaborative diligence. We should have discuss with the other angel investors at least to get some kind of inputs. They don't have to invest into that company, but it's okay to check with the other angel investors about the startup that we are looking at. Exit strategies and the key takeaways. Acquisition is the most common exit, which may happen in between like a 3 and 7 years of the startup inception. IPO is the rare activity that will take even 10+ years. Secondary sales also, it's a very common thing to happen. So as I said, acquisition and secondary sales are the best bet. And angel investors, we can invest and also should exit during this acquisition or secondary sales. Sometimes if we wait for the IPO, that may become a disaster also. Key takeaways: diversification is critical. The due diligence, psychology impacts, a strong team matters, and also plan for follow-on funding. These items are very, very important for any angel investor. Actionable insights: create a template, to do all the risk assessments for all the due diligence process. We can all have like a standardized template or standardized framework for the due diligence. That even if any of you have any kind of template, process, feel free to share to other angel investors also. Allocate the capital for time period, like at least 3 to 5 years time period to make investments. Not every investment should happen at a single time. And clear expectations with the founders about our involvement with the startup. Sometimes while discussing with the founder, they will clearly say, please don't involve on these matters, or please provide guidance or suggestions on these matters. They will also clearly set the expectation. We can also set the clear expectation and also about the exits. These are like a top 5 Indian failed startup. If you look at this one, housing.com raised 139 million US dollars. They raised successfully from angel investors, pre-seed, seed, and also from SoftBank through Series A. But still, it failed. The main reason is wild expansion, reckless marketing spend, leadership chaos, and also high monthly burn rate. Then a company called Hike Messenger, Tiny Owl, Dudwala, Stazilla, they successfully raised very good money, but they are not able to execute properly because of so many reasons. They wanted to scale, they wanted to expand very fast and very early, even obtaining the profit or even before reaching the break-even point. So those are all the things that need to be taken care. This is my like a short profile. I founded like 3 companies. And the first company I made like a idea to exit like 8 years. And other 2 companies, I ran the company, and also Wilco Labs acquired by Wilco Source, and Wilco was given to another friend company. I've been in the technology industry for 30 plus years. I would say I'm like techie guy turned entrepreneur. So first 15 years I was working like in full-time job. Then only in 2014 I started my own company, Wilco Source. And angel investments, I have made like a 27 in India, 17 in the US. I'm like a limited partner in 2 VCs in India and 2 in the US. I've been mentoring, advising companies both in India as well as in the US. I've been like investing since 2021. As I said, 0 exits so far, and also like 2 failures. Tender cuts is the one I wanted to mention as like a fear of missing out example, right? When you all may know that Tender cuts is a meat company. I think they started in 2019. They made very good revenue. They expanded very fast. And also in 2022, they wanted to raise like a bridge funding. So I invested in bridge funding, but 2023 they were not able to raise the subsequent funds. So they sold the company to I think Good to Go. But now the Tender cuts is profitable. In August 2025, it became profit, and they even exceeded the break-even point. But they shut down the operations in Hyderabad and Bangalore. They have operations only in Chennai now. They wanted to expand again in Hyderabad and Bangalore only in 2027. Now the founder learned all through the experiences. Now he takes steps very slowly and strategically. And this is my LinkedIn profile, my US number, and also my India number, and my personal email. So these are all my like a diversified domains. So though I have invested like in 44 companies, but if you look at the domains for advertising, 1 investment, for like a FMCG, 6 investments. So these are all like a diversified domains across the like portfolio. And that's it. Thank you so much, everyone. Have a happy and a safe Diwali.
Thank you, Sundararaman sir. It was really a nice session. So, investors, any questions you have?
Good afternoon, Sundararaman sir. Thank you for the wonderful, insightful session. Can you please advise us, like, what is the minimum ticket size? Like, you have clearly given us a strategy in terms of like minimum 10, minimum 10, and maximum could be like 20 plus or even up to 30.
Yes. Yeah, between
So what is
between
yeah.
20 and 25 is the ideal size. But you can start with you can keep the like a 10 is the bare minimum. Mainly the investing into more companies to increase the probability and to increase the chances of successful returns.
Okay, sir. What is the minimum ticket size? Like what is the amount that we can invest? Because if you have to increase the number of company. Also, please, you have given the kind of some
Yes.
criteria like 20 to 30. And also
Yes.
in terms of the ticket size, how much is the risk we can take,
Some
like the risk exposure? How much you recommend based on your experience? How much we can invest
yes.
in each company?
So, based on my experience, if while negotiating with the startup or founders, not many founders will accept for decreasing the ticket size. If they come up with the 10 lakh minimum ticket size, they are, adamant in keeping the 10 lakh ticket size. That's why I started investing through syndicate. Through syndicate, the ticket size will be very less. Some investments I have made through syndicate even for 75,000, even for 1 lakh or 2 lakh. So you can pick the size. They will tell us minimum is 50,000. We can do in multiples, whether we wanted like 2 times of that 50,000 or 3 times of 50,000. So syndicate is the better option to invest in the smaller ticket size.
Okay, sir, that's a good idea. So, in your opinion, the syndicate are different from the angel network, like those actually the company that actually bridge the investor and the startup. So, the syndicate is a different entity, in your opinion.
Yeah, the main advantage is they do all kinds of detailed due diligence. At the same time, the ticket size also will be smaller because they would have a list of angels or network of angels in the syndicate. So instead of going to one person, they may broadcast about the startup to 50 or 100 angels.
Come again, sir. I'm trying to understand.
No, instead of reaching out to one angel investor, they would have a network of angels within their syndicate. So they can reach out to many people because the investment will happen into the startup by the name of syndicate, not by my name, by your name.
Yeah. Okay. Okay. So, like in this case, like Startup Singam or Native Angel Network, they can be
Yes.
called as
Yes,
syndicate.
that's correct. Native angels, native lead, peaceful progress. Last month, Chandrasekhar Kupperi gave us one session, Zoom session. He runs a company called Peaceful Progress. That is also a syndicate.
Okay. Thank you, sir.
How do we assess the valuation, like whatever valuation that they say? How do we, is there some method, basic method through which we can kind of make some guesses?
Yeah, that's a good question. Sometimes, the valuation they come up with, very difficult to assess because some companies, even at the time of idea stage, even the pre-revenue stage, some companies comes up with 50 million US dollars valuation. That is not at all possible. The only way we can do some kind of assessment is who are all their competitors and how much the revenue they make and what was their initial valuation at the time of fundraising. So we can compare with those kind of similar companies. And even with the startup that we are discussing with is, what kind of revenue projection they do have for the next 2 to 3 years, whether they even come up with some kind of projection. What are the plans to achieve that projection? Do they have any kind of a pipeline like leads, prospect, customers? What is the plan? Asking all those questions will help us to assess the valuation part. Of course, we can talk with some kind of financial expert also. Of course, each and every one of us will have our own chartered accountant in India. In the US, we would have CPAs. We can, of course, check with them also. Hey, this is the startup, this is the pitch deck I have received, and this is the valuation they say. What are your thoughts? Please do some kind of, research and let me know. So I have done with my chartered accountants also in the similar fashion, because sometimes it's very difficult to to validate the valuation.
Good evening, Mr. Sundararaman. It was a very useful and insightful presentation. My question is on the engaging with the angel syndication. If you go through a syndicate, are we not getting into one more level of risk? Because we do not know whether the syndicate will do a proper job and how they do the job, we may not know. How to address that issue?
Yes, they will be doing that, detailed due diligence, but at the same time, no one can predict, this company will win or this company will fail. No one can predict. From the risk perspective, I would say if we go with the syndicate, our ticket size can become smaller. our risk-taking level will be smaller. So let's say if we do have 10 lakhs to invest, if we go to the syndicate, we can invest at least 1 lakh each into 10 different companies. Not all, definitely not all those 10 companies will fail at the end. Of course, 2 to 3 companies definitely will fail. But at least we can get the returns from 6, 7 other companies.
We'll be spreading very thin amongst various companies. If you put a small investment, say 1 lakh, 2 lakh through the syndicate, we'll be spreading it very thin.
Well, yes, that is all. That's why I mentioned what is our threshold. If we do have only 10 lakhs to invest, this is the best way or best approach to do. If we do have 1 crore and we are able to, invest in 10 lakhs, we can, of course, directly work with startups and founders to invest 10 lakhs in a company.
Okay, thank you.
Sir, after we invest, how do we track or how do we, any process to ensure that, they are going right or anyway, we are kind of doing it through either Startup Singam or people like Native Lead, right? So how do we kind of have that peace of mind after investing, sir?
So that's another point I thought of mentioning. So in my experience, getting the regular updates from startups is very, very big challenge. Initially, while talking with the founders, they would say, monthly update, quarterly update. They say all those blah, blah, blah. But once the pre-seed is done, seed round is done, getting the periodic at the regular interval updates is very difficult. I have I emailed to many startups to send the updates. Of course, there are very few companies who would provide consistent updates even without asking them. They provide updates and also they are available to answer any kind of questions. But that happens only with very few companies.
Good evening, sir.
Majority of the companies, is not good in providing the updates. That's another point, right? If we invest through syndicate, at least we can ask the syndicate what happened to the update. So it's a syndicate's responsibility to get the proper update from the startups.
Do you think building any kind of relationship with the founders will help in this case in any ways? Or it will be like futile time?
That may help only if you are familiar in the same domain in which they do the business. Having a friendship or having a close relationship with the founder, the transparency may be higher, but I don't think that will help like in any specific or in any special way.
Thank you, sir. And how do we think about exit process, sir? Like today we invest. When do you think we should exit? In 3 years, 2 years? What is that? What do you suggest?
Minimum time 3 years. Okay. And even after 3 years, that the exit can happen only through some secondary sales or acquisition. If the business is very strong, if they started, good revenue. Otherwise, that may take like 7 years or 8 years to get good returns. So that's why I keep saying, even through the secondary sale or through acquisition, if the return is 2.5x or 3x, we just should grab it and making some other investments. If we expect more returns or if we wait like a longer period, that should not end up any kind of like a failure or a disaster.
Thank you, sir. Very good insights, sir. Thank you, sir.
Good evening, sir. First of all, I would like to thank for the wonderful session which you have given here. So my question to you is, what is the common mistake you see in early stage startup when they are pitching to HNIs, and how can we catch up with them?
Like overvaluation and also, very optimistic projections. Some startups I have seen, they haven't even started generating any kind of revenue. It's like a pre-revenue company. But when we look at their projections, in 2026, we reach, 20 crores, 2027, 35 crores. If we look at their projections, exaggerating so much, so we can catch from that numbers itself. And EBITDA is another factor we should look at, some companies make very good revenue and the gross profit margin may be good. When we look at the EBITDA percentage will be very less, even zero or in negative.
Thank you, sir. Thank you.
And also, Naufal, thanks for sending the reports, I think done by third-party Arcwise,
Yes,
right?
sir. Yes, sir.
Yes, it's good that they have provided most of the metrics, but I see like two more metrics will be helpful.
Yes, sir.
How much cash they do have in bank, right?
Okay.
And using that cash, what will be their runway, even if they are not, even if they don't raise any money.
Okay.
So that will help angel investors.
Definitely, sir. I take this point with the third party audit team.
Thank you. But that report covers most of the metrics. Thank you.
Sure, sir. Thank you, sir. So, investors, any questions you have?
And also let me know if anyone wants me to share this. I'm open to share.
Yes, sir. That will be helpful, sir.
Okay.
Definitely, sir. You can share the deck with me so I can share
Sure.
it with everyone, sir. Whoever is requesting for that deck.
Yeah. And also, as I mentioned, I think we should use this WhatsApp group very effectively, for all the clarification questions about the startups. I may hear about some new startups I can share in the group. Similarly, you can also do the same.
Definitely, sir.
I met others also.
Sir, one more question if I may ask.
Yeah.
So you kind of mentioned, a word, it kind of a disaster for exit, something. I couldn't catch up your thing. I don't know what context you mentioned that, it would be a
No.
disaster to exit,
Yeah,
something like
big.
that.
No. Like, for example, if a big company wants to acquire a startup in which we invested, only their due diligence process will be very exhaustive. They may hire a third party like a PwC, E&Y. They go through everything. Their due diligence process may take 8 months or even 1 year. So at that time, they may be able to find out some kind of legality issues. Okay. So if we wait for more time, 7 or 8 years, and while doing the acquisition, if they find any kind of legal issues, then the acquisition may not happen. Then that legal issue will become public. Then other companies may not come forward to acquire the startup. So all these things will happen.
So what is the best strategy in this case?
Best case scenario is a secondary sale. If anyone is interested, to exit the investors at the time of Series A funding or Series B funding, we should take the money. We should come out.
Okay, thank you, sir. So where you are located, sir, if I may ask, please?
Currently, I'm in Coimbatore. I have come to India for the personal, but I'm a US citizen, living in both Florida and also San Francisco.
Okay, thank you, sir. And in your opinion, what are all like since you are based in US, you have some better exposure in terms of the tech sort of, that will be thriving the short, mid, and long term. Like in your opinion, based on your entrepreneur yourself, can you give us some understanding, like what are all, kind of the area, the potential investment area you think you could share with us, like sort of
No,
we
definitely.
can.
So right now, not just in US, across the globe, everyone talks and everyone makes investment in AI. Even if any company doesn't have AI implemented before, now they introduce some kind of AI technology to their product or to their business. They wanted to call their company as AI powered company.
Okay. So like, so which area of which investment area you will suggest to us?
Healthcare is the best.
Healthcare, because healthcare itself lot of verticals, a lot of elements,
Yeah,
product lines. Which product line in particular you're talking about, sir?
Healthcare and life sciences, pharma technologies, pharma companies. So in my experience itself, I have founded that Wilco Source company, right? So that is like a software services company. So in the software services company, fortunately or unfortunately, I don't know, I kept Salesforce platform as the technology and focusing only healthcare and life sciences domain. I focused only in that domain. I focused only in the Salesforce platform technology. That really helped me, especially at the time of pandemic. During pandemic, so many companies in other domains, either shut down or, the revenue went down. Since I was in like healthcare life science, to be honest, my revenue actually became doubled year on year after 2020.
Okay, great. So what is the line you're trying to draw, sir? Like what you're trying to say?
No, healthcare is the best, I'm saying.
Best, okay.
Because definitely everyone gets sick.
Right. And what about advanced manufacturing, sir? Advanced manufacturing, now also our Sridhar Vembu sir talking much on the India has to be like, product. I mean, we should be focusing on the product instead of just serving as a service provider. So product is something, it's like a tangible. We can see like that we
Yes.
actually physically we are doing something that we are actually exporting or providing, in India, in India actually, I mean, local, for development.
That's right.
So like, which are the product, you think, could be in the coming years, like, in the area of robotic, in the area of drones. If you can give us some understanding, that would be helpful also. Like which product line that we can actually focus.
Yeah, you mentioned that manufacturing, right? Even within the manufacturing, I would suggest EV, the electric vehicles. It can be like a motorbike, or it may be like a car, or anything, any kind of autonomous technology. I think people, give importance and also give more focus, and also they get more funding.
Okay, sure, sir. Thank you.
Thank you, Nandan sir. So investors, any quick questions?
No, I'm good. Thank you.
Okay. Thank you, investors. Thank you for joining for today's session.
Thank you.
Sundaraman sir.
Thank you.
It
Thank
was
you,
really a
everyone.
wonderful session.
Thank you,
sir.
Thank you. Bye.
Thank you, Noful, for arranging this.
Thank you, sir.
Thank you. Thank you very much.